Good morning, Bitcoiners. Hello, and welcome back to another edition of your Bitcoin Economic Calendar. I'm Mauricio Di Bartolomeo, co-founder of Ledn, and as with every week, we bring you the news and analysis you need to start the week off right in Bitcoin. Today is February 22nd, 2022, and we have a great episode for you this morning, as always. In today's issue, we're going to start by looking at Bitcoin's long-term demand model and comparing Bitcoin's demand model to that of the internet users, and mobile phone penetration, and draw some insights from there. We are also going to be looking at gold, which has rallied more than 6% this month, and we're going to take a look as to why and what we can expect going forward. Last but certainly not least, we're going to look at NFTs as prices have tanked after a report of an OpenSea phishing attack circulated last week. And hot off the press this morning, a report just recently revealed the potential identity of one of crypto's largest hacks in history. So we're going to touch on that as well. Grab your coffees. It's going to be a great one. And starting as we usually do with Bitcoin, we see that after reaching a high of almost $45,000 last week, Bitcoin has dropped nearly 15% on very low spot trading volumes. This is the bar here that shows this week's spot traded volume so far. This is the spot traded volumes from last week, which again, we see that they are on the low end of essentially the last 6 months. And just to look at the magnitude of the drop, we're just going to draw a line here from top to bottom on the drop, and we see that it's actually right now it's basically down 15% basically from a week ago, but it's been as low as basically down 19% in a matter of essentially 10 days. So the recent selling pressure has not been limited to just Bitcoin. Risk assets across the board have been selling off. We're going to dive into why volatility could stay with us in the short term and why the long-term network outlook for Bitcoin remains very strong. So first, let's go into some of the reasons behind the recent volatility. And for that, we wanted to provide some context. And we are going to now show the price essentially here. This chart right here is the ARK Invest Innovation Fund, and this is Cathie Woods' innovation fund. It's been a darling, essentially was a bit of a darling all the way through 2020, and it's been essentially on a downtrend since a year ago now. So as you can see, the Cathie Woods' ARK Invest ETF has dropped by essentially the same amount as Bitcoin so far. So it's dropped about 15% over the last 14 days. And it has dropped, and it reached a new low last week. Essentially, this is a new, sorry, I'm just going to undo this. So staying with the ARK Invest ETF, we see here that it essentially has dropped quite significantly, and it's reached a new low this week in this week's session. So, and there's an article here speaking to that, essentially. This is actually circulated yesterday, and it's talking about how much this ETF has suffered in particular. And again, this is really just to show that the selling pressure on risk assets has been pretty broad-based. Now, the market is facing quite a bit of uncertainty, both on a macroeconomic and a geopolitical front. We're going to touch on both of those just to give some context. So on the macroeconomic front, the markets were already having to deal with the US Federal Reserve tightening their monetary policy and planning to raise interest rates as early as March 15th. So risk assets, broadly speaking, have been under pressure since the Fed announced their plan to gradually taper their bond purchases and eventually let interest rates rise. The Fed first signaled this in November, and at their November meeting. And if we look at when Bitcoin peaked, it just so happens that it was right at that meeting. It's right in between the meeting. The meeting happened on the 13th. So between the 8th and the 15th, it was when Bitcoin essentially reached its peak last year, so far, the local peak. So that has already been weighing on the markets. The Fed has announced that they're going to increase interest rates, and they've announced that they're going to taper bond purchases. They have slowly started tapering, but the first interest rate hike will not likely be announced until March 15th. So again, the market's already having to deal with this impending interest rate hike from the Fed that's just weeks away. Now to the geopolitical front. So let's pop up this recent headline which I'm sure many of you have already been reading about, with the tensions that are happening between Ukraine and Russia. And these tensions and this potential conflict has dominated headlines over the last 10 days or so. And they are very much impacting investor behavior. The recent price action in Bitcoin indicates that investors may be exercising caution into the current environment. With the Fed meeting, again, the Fed meeting is just 3 weeks away. So as we covered here last week, in addition to these two things, there's a third potential wildcard, which is that, as we covered last week, there continue to be rumors of a possible executive order from the US White House to task federal regulators with overseeing the crypto industry. Again, this is an article on this topic that we were just talking about. Now, how are the markets doing in light of all of this? Let's take a look at some of Bitcoin market fundamentals. So for one, let's take a look at the implied annualized 3-month rate. 1 second. So this is the implied annualized 3-month rate. And let's just highlight a few, let's just single out a few exchanges here so that we can appreciate this a little bit better. Because what we want to see here is essentially the trend. And let's do OKX and Binance. So as you can see here, what you have in front of you in this chart is the annualized rolling 3-month basis. So what this really means in plain English is this is this difference here, this percentage chart. What you see here is this tracks the delta between the spot price of Bitcoin and the futures contract that is for 3-month out delivery, okay? The difference between the price in the 3-month out delivery Bitcoin and the current spot Bitcoin divided by the spot Bitcoin gives you the implied yield or the implied interest rate that an investor could earn if they were to buy spot Bitcoin, sell 3 months out futures contract, and then deliver that Bitcoin at the end of those 3 months. And what that does is that it calculates an implied interest rate based on what you're investing. So if you're going to make $1 and you're going to invest $10 and you're going to deliver it in 3 months, you're basically going to make 1% on that investment. And if you could do that 4 times throughout the year, then you could basically earn 4% on that investment. And that is how you calculate the annualized premium on this on spot versus futures. So now that we have said all of that, what we can see clearly here is that interest rate has been coming down dramatically, okay? And what that does is that it makes that initial trade that we just discussed, buying the spot Bitcoin and selling the future, it continues to be less and less attractive. Now, there had been many investors that had been taking advantage of this carry trade. As you can see, as early back as November, an investor could earn a 13% annualized return by just selling the future 3 months out, buying spot, and delivering that Bitcoin when the time came due. We have seen that interest has now been compressed astronomically. Where we were essentially double digits, north of 10% in November, we're essentially right now at around 3% in the current month of February. So that's a big drop in a very short time span. Now, other things that we are seeing, which is very interesting and is related to this, is the fact that the open interest for Bitcoin futures has also been shifting. And this is here, the aggregate open interest for Bitcoin futures across platforms. The very interesting thing to note here is that this was at 15.6 billion literally 6 days ago, and it is at 13.3 billion right now. So that is essentially, $2 billion worth of open contracts or open interest that have been essentially evaporated. They have closed out over the last 6 days. If we assume that some of these investors were participating in the carry trade, i.e. these were investors that had, bought spot Bitcoin and sold the 3-month out future contract, they have an open interest of an outstanding contract that they have to deliver. If we assume that these were people that were participating in the carry trade, then for them to unwind their entire position, they would have to then buy back the future contract that they sold, closing out the open interest, and they would also have to sell the Bitcoin that they bought on spot to essentially get rid of their entire position. Now, that entails essentially closing out the open interest and selling the Bitcoin in the spot market. This dynamic, when you're unwinding this trade and you are essentially buying back the future and selling down the Bitcoin in the spot markets, this adds further selling pressure to the Bitcoin spot market. So, while the total interest, or the total interest on the futures, the total open interest, and let's just pop this out to a yearly view so you can see what we're talking about. So as you can see here, even at the current levels at 13.3 billion, open interest on futures remains somewhat elevated from where it has been historically. We see here that just as you know, in June of last year, it was trading at around 10 billion. So it has come down dramatically, but it's still relatively high given the historical values where it's traded in the past. So what this means is that this trend could continue as more investors could look to deleverage into the current uncertainty. So noticeably, another interesting point here is that the short interest in Bitcoin, so like the number of people that are taking on short positions on Bitcoin, has not made a new high since essentially November of last year, even though the price is currently trading lower than it was in November. So that tells us, you know, in some ways that it's not necessarily that investors are looking for Bitcoin to you know, go further down. It's more of investors not wanting to add to their leverage, and they're not necessarily looking to add to their short positions. They're just essentially trying to be hedged, it appears, from what we're seeing in the market. So now that we've covered a lot on the sort of short-term volatility and dynamics, let's switch gears for a second and take a look at Bitcoin's long-term network model. So the chart that we're about to share is courtesy of Jurian Timmer at Fidelity Investments. And here is Jurian's chart, which we thought was, he had a brilliant thread over the week and wanted to share it. And what this does is, in his thread, he compares the demand model of Bitcoin to the demand model of mobile phone users and internet users. And as you can see here, the model takes into account Bitcoin addresses with Bitcoin addresses with non-zero balances, as well as Bitcoin price, and the growth of mobile phone users per 100 people, and the growth model of internet users as a percentage of the population. As you can see from the chart, the path for Bitcoin's network effect remains intact and on trend to be similar to that of mobile phones and the internet. Now, while it's easy to get caught up in the short-term volatility, it is helpful to zoom out and look at Bitcoin as a multi-decade technological and monetary phenomenon that it is. So, more on this in our future sections. And now moving over to an analysis of the S&P 500, we see that equity markets continue under pressure given the current geopolitical and macroeconomic backdrops. The Federal Reserve is trying to wrestle with soaring inflation in the US. JP Morgan analysts now expect, this is the headline we wanted to pop up, JP Morgan analysts now expect up to 9 interest rate hikes, each at 25 basis points, between now and March 2023. Now, there are, this week there's several Fed speeches, with most investors expecting the first interest rate hike from the Fed is being expected by most people during their March FOMC meeting, which is on March 13th to the 15th. That being said, we do have more speakers on queue this week, which will likely add color into some of the Fed's plans. If we play out JP Morgan's scenario, and just for a thought exercise here, JP Morgan expects the overnight interest rate to reach 2.25% between now and March of 2023. For context, the current yield on the 30-year US Treasury bond is 2.25%. This typically means that for the raise to happen, for the Fed's plans to essentially unfold, the yield on the 30-year bond would have to rise to be much higher than 2.25%. Otherwise, the curve itself would be flat from beginning to end. It would be 2.25 on the overnight rate and 2.25 on the 30-year rate, which makes no sense. This is rising rates, as everyone is expecting, do have a negative impact most of the times on the economy. For one, and we're just going to break down why that is, for one, when you raise interest rates, it significantly slows down the rate of growth in real estate asset prices. And there was a great chart over the weekend by Alf, who is at Macro Alf. And this chart I thought was really insightful in that it tracks the cost of a mortgage with the average price gain of houses in the United States. And this has a 1-year lag for the model. But as you can see here, essentially, as the mortgage cost, which is the number in the orange line, as the cost of the mortgages goes higher, which means the orange line going down because it's inverted, it means that the average growth of house prices will also go down if history is any guide as to what has happened in the past. And that makes perfect sense. The higher the cost of a mortgage, the lower the average price of the house that you can afford. And so this is just, interest rates eating into the purchasing power of Americans. The other way that rising interest rates affect the economy in general is that by letting interest rates rise, you're letting the risk-free rate rise. The risk-free rate is essentially the rate at which you can have money deposited into the United States and earn interest from it. So from a government security in the United States, a government bond. The risk-free rate, which many deem as essentially the overnight rate that the Fed sets, this affects most corporate valuation models. If any of you are familiar with this, when you have a company that has cash flows into the future, you have to discount those cash flows by the current risk-free rate or the current cost of capital. There's many models that do this. So as you discount the future cash flows at a higher interest rate, that essentially reduces the net present value of your calculation because you have to basically attribute more to the cost of capital, and that basically takes away from the present value of the entity that you're trying to evaluate. This creates a very complex issue for the US economy. As we've mentioned, both real estate and the stock market are the two largest sources of wealth in the United States. And depressing the prices of both of these assets will definitely dampen economic activity and growth. So essentially, the Fed is trying to engineer a slowdown on the economy without causing a recession. And to quote Sultan Poznar from Credit Suisse last week, which had a great article about it, the Fed has never managed to accomplish this. So there is no longer debate about whether the Fed will raise rates on March 15th. The debate has moved to how high will the rates go on March 15th. Even if there is a de-escalation of the Russia and Ukraine tensions, the stock market relief could be short-lived as the pressure from the Fed might be hard to overcome. So more details on what we can expect this week. Moving over to gold, we see that the yellow metal has had a great week last week. It soared over $1,900 per ounce, and it basically rose more than 2.14% last week. This is essentially, it reached $1,900 for the first time since May of last year, which is pretty impressive. Now, if we look at the recent rally over the last 3 weeks, we see that gold is up essentially around 6.5% over the last 28 days. Actually, let's take it here from the top, from the beginning of the month. So as you can see here, it's basically more than 6% gain in the last 28 days, and at a $9 trillion market cap. That's a pretty significant gain for gold. The positive price action for gold, no surprise, has been on the back of the recent geopolitical tensions, high inflation reads, and steady bond yields in the US over the past 2 weeks. Here is a recent article from Yahoo Finance. So here's the article on your screen from Yahoo Finance talking about the recent run-up in gold prices. Now, interestingly, if we look at the US dollar index, we see that the US dollar has essentially remained pretty flat throughout the recent geopolitical tensions. This is not usually the case. The US dollar typically tends to rally in the face of geopolitical tensions and uncertainty, but we're seeing that this has not necessarily been the case this time around. A potential de-escalation of the current situation, the current Russia-Ukraine tensions, could result in the dollar index dropping. And this could act as a further tailwind for asset prices. So something to keep in mind as a potential follow-on from a resolution or potential resolution out of that conflict. Moving over to our DeFi analysis, we see that both the DeFi index and Ethereum were under pressure last week. The DeFi index finished lower by 6.5%, already down by around 6% this week. Ethereum finished last week down 8.77%, down 1.25 or 1.14% so far this week as well. Now, there was a big report that broke this morning, and that was essentially the report from Laura Shin, who was a reporter at Forbes. And her report earlier this morning revealed that there's new research suggesting that she has uncovered the identity of the Ethereum DAO hacker that occurred back in 2016. And this is a big deal, and we'll get into why. For context, the the DAO hack, and it's a fascinating article. Welcome many to read it. And she actually is publishing a book which will have more details around this. But for context, the hacked assets from that hack way back in 2016 would be worth approximately $11 billion at today's prices. Now, the suspect hacker has been identified as Toby Honish, and the article states that he grew up in Austria and was living in Singapore at the time of the hack. Until now, he has been best known as his role and co-founder and for his role as a co-founder and CEO of 10x, which had raised $80 million in a 2017 initial coin offering to build a crypto debit card, which failed. And so very interesting that this person's identity is potentially being revealed. This report will likely trigger a widespread investigation into the hack. And another interesting note from the article was the fact that Shin disclosed that Chainalysis, a technology firm that basically does on-chain forensics for blockchain networks, has essentially disclosed technology that could reportedly unmix Bitcoin coin-join processes like Wasabi Wallet. We will cover this at length in our next issue, but it was something that we wanted to highlight as we thought it was pretty interesting. Moving away from this hack and into other exploits, unfortunately, NFTs made headlines once again last week when some OpenSea users, OpenSea is a very popular NFT trading platform, some OpenSea users reported that some of their NFTs had been stolen from their accounts. Reports mentioned that some OpenSea users received phishing emails several weeks ago, and these emails took advantage of an exploit to make users pre-approve the transfer of their NFTs to the attacker at a cost of 0 ETH. The attacker then executed the plan over the weekend, and OpenSea clients started reporting the attack while the OpenSea CTO was reportedly giving a speech on stage at ETH Denver last week. So pretty interesting and pretty complex attack that was carried out here. How this impacted NFT prices is a very interesting question. So NFT prices reacted quite negatively to the news with the Bitwise blue chip NFT indexes, both of these here, which we highlighted last week, now have turned into negative year-to-date performances, even though these were both positive as of last week. So both of these indexes have dropped by more than 10% since the announcement came. Again, we will continue to monitor the reaction to this attack. Moving over to our section on Bitcoin mining, we see that the Bitcoin hash rate made an all-time high at 213 exahashes, and it's now up 141% since the China mining ban bottom of last year, which is this little bottom here. Last week's difficulty adjustment brought up difficulty up by 4.78%. The next one should kick in next week, and expecting to bring difficulty slightly down to around 2% during the next epoch. Taking a look at the mempool quickly, we see that the mempool has had a few activity spikes. Just going to wait here for them to pop up on the monthly. So we see here that we're starting to see a few activity spikes as of recent. However, transactions are getting absorbed pretty quickly, and transaction costs and speed remain optimal at the moment. And as always, we wrap up with what's ahead for the week. The week ahead, we'll have Fed speeches, economic updates on the US real estate market, and the US inflation. Additionally, we do have potential headlines given the situation in Russia and the Ukraine. This will be very hard to predict, and we will continue to see volatile headlines around that situation as it continues to develop. So going into what we have on queue for the week, on Tuesday today, 9 a.m. Eastern, we got the S&P Case-Shiller Home Price Index. That is going to show the year-over-year increase or change in prices in U.S. real estate. For the record, the December increase on an annualized basis relative to December 2020 was 18.8%. So a lot of eyes are going to be, trying to figure out, or there's going to be a lot of eyeballs on this report as many investors are trying to see where the trend is headed in this very, very fast growth in U.S. real estate asset prices. Wednesday is quiet. We don't have anything on tap for Wednesday. Thursday, we get 10 a.m. new home sales in the U.S. Again, many investors are now looking at the impact on home sales given the announcement of the Fed that impending rates will rise. And then on Friday, we close the week with personal consumption expenditures inflation. So PCE inflation is a number that the Fed looks at very closely. Then at 8:30 a.m., we have the 5-year inflation expectation for the U.S. And at 10 a.m. Eastern, we got pending home sales in the U.S. So all pretty interesting data points. The markets will be paying close attention. It's a big week coming up. We'll keep you posted right here on any relevant info. Thank you once again for staying with us, watching, reading, listening, whichever format you are reading, watching this. Thank you so much. If you enjoyed the show, if you learned something, we welcome you to thumbs up it, like it, share with your friends, and subscribe to our channel. If you don't yet have a Ledn account, I welcome you to check out ledn.io and learn how you can start earning the best interest rates on your favorite digital assets. We also have the best interest rates for dollar loans if you want to borrow from your Bitcoin and not sell it. And we also have our most recent product, our Bitcoin mortgage, which lets you purchase a house as big as your stack. Thank you everybody for staying with us. We'll see you right here next week. Have a great one and see you soon.